I think we can switch to English now if it's not a problem. So yeah, let's start. So the topic today is called financial development or financialization. So basically, those are like two sides of the same coin. And I want you to be aware of this with this small guest lecture that I'm giving now. So we're going to talk about how the financial system impact the real economy, because we're going to have a differentiation between the real economy and the financial system. Real economy or the real system is basically, for simplicity, we're going to consider it to be basically households, like basically you and me, all the houses with all the people, like individual people, plus non-financial corporations. So those will be like the ones who integrate the real economy. And we're gonna take a look on the effect that the financial system has in the real economy. How does it impact the real economy? And then we're gonna talk about growth, because usually we tend to think that growth is always for the good. But what if the financial system grows? Is that good in the end for the real economy, or maybe not that good? We're gonna think of that a little bit. And finally, we're gonna talk about the role that banks especially play in the current financial system, because among all the intermediaries, I think the banks are really important. They play an essential role, and their activities impact all the economy as a whole, both the real side and the financial side. So we're gonna take a look at that as well. So yeah, we're gonna talk about banks, and first of all, we need to be aware that banks are important. Banks are really important. Why? Because in the financial system, as you know, we have many intermediaries. We we have banks, but we can also have, I don't know, another credit institutions. We can have pension funds. We can have hedge funds, individual investors. There's many people who actually can canalize that flow of money from people who are in surplus, or from people who have more than they need, to the people who are in deficit, or the people who have less than they need and actually need to borrow money. So why are banks important? Basically because banks are the sole financial institution that can create money. By creating money, I mean create money out of nowhere. When there was nothing, there's money. We're going to talk later on how this works, but just keep in mind for now that banks create money. And this is really important because, as we will see later, that's what makes the real economy flourish, grow, develop, and that happens when loans are given. So banks, as you know, give loans. Is one of their main activities, basically taking deposits and giving loans. So by giving loans, they're creating money out of nowhere that goes in the economy. So let's imagine, for example, I don't know, we have a pretty good idea. Let's say we want to build a farm, and because we want to develop a new kind of cheese, which is really good and also like environmentally sustainable. I don't know. So we have this idea. The idea is cool. The idea could make us really rich and also could benefit the society as a whole, because then they will have a really good cheese. And in the way, we would pay a lot of people who work for us, so they would also become richer. But we don't have the money. We don't have the money, so nothing can happen. So all of us are losing something. That is the moment where banks take place. Banks arrive and banks say, okay, I'm going to give you a loan. I'm going to give you money. Obviously, banks have to carry out a previous assessment. My banks don't give money to literally any person, but banks can say, okay, I think your idea is profitable. I think you have resources to pay back. I'm going to give you the money. And then everything can happen. You have the money, so you can create, let's say, the farm, for example, and then the economy grows, there's development, and there can be innovation because we're creating a new kind of cheese. The cheese is sold in the market, people like the cheese, so we earn money, we can pay the loan back. And in the way, we've paid many people who are working for us. And then some people in the society like our cheese, so they are consuming our cheese, so they are better off, and we are better off because we have more money. So in the end, everyone benefits. And everything started just by a bank giving us money, which was created out of nothing. That is the main idea. But we're gonna go through this a little bit later. But now I want to talk a little bit about the money multiplier. I don't know if this is still part of the course. Probably yes, because when I took this course in my bachelor's, like in la carrera, I also had this money multiplier theory, which is not completely wrong, but I mean at the bachelor's level is really useful. But there's a twist in this, and the thing is, this is about money creation by banks, by commercial banks. So if we assume the money multiplier, you probably have studied this, so I'm not gonna explain a lot. But I mean, you know that this is basically that the central bank, CB, there in the presentation is central bank, issues some money. So they issue some money, they give the money to the commercial bank, and then they say, okay, you're gonna have this money, but then you have to keep like a percentage of the money in reserves. Like you cannot lend the whole amount of money. Let's say you have to keep a 2% in reserves. So the bank says, okay, I'm gonna keep, I don't know, imagine they were given 1,000 euros, so they keep 20 euros as reserve, and then they can give the rest of the money to customers via loans. So then out of the initial 1,000 euro, only 98% of that money goes again to the economy. So then that money is again put in another bank with again the same reserve requirements. So every time the money flowing to the economy is lower until we reach the point in which there is no more money. So that implies that central banks can fully control the money supply. The money supply is the total amount of money that is in the economy. And that money is limited. It depends on the amount of money that the central bank issues. And that is not true at all. Why is not true? Because we're assuming that banks, commercial banks, need to have that money in advance to give a loan. It means that you need to have deposits to give loans. And in reality, that is not true. That is not true because what is a loan? I mean, we need to think of what is a loan. We don't, I mean, because the problem is that intuitively, we tend to think that loans are physical money and loans are just numbers typed on a computer. If you go to the bank and you ask for a loan, I don't know, a 10,000 euro loan, and the bank says, okay, I think you're trustworthy, I think you can give the money back, I'm going to give you the loan. What happens? The bank is not directly in that moment giving you cash, like coins, banknotes, no. They just go to your account in their computers and they type, okay, this person has 10,000 euro more in their account. They just change the numbers. And then you go to your online bank no physical money involved. Obviously, if you want to go to the cash machine, to the ATM to withdraw some money, then the bank needs to have money. But as you know, not all the customers want to withdraw money at the same time. So the process of giving a loan is just typing some numbers on a computer. It's just air. It's nothing physical. So banks don't need deposits to make loans. If they think that the customer is good enough, that is quite sure that they will repay the loan, they will give the loan. And it works like this. So the reserve requirement by the central bank is not something that can determine the money supply. They have another tools, of course, but not that one. So since everything's based on confidence, you could think that okay, then banks can create any amount of money, like infinite money. But no, it doesn't work like that because at the individual level, every bank has to meet some regulatory requirements. I think you haven't covered this yet, but you will in Gestión Bancaria. I think we did in the last two topics of the course, but there's a lot of regulation by the central bank that says, okay, you need to have capital requirements, which basically is that you need to have a certain percentage of capital for the loans you're giving. So the more loans you give, the more capital you need to have. Because basically, if you have a loan and then the person you gave the loan doesn't pay the loan back, then you need to have some capital to absorb the losses because you're losing money as a bank. And their capital requirements go. And then liquidity requirements is the thing I was talking about before. I mean, some customers may want to go to the cash machine, to the ATM to withdraw their money. And you need to have some money for them. But not all of them will want to withdraw money at the same time. So you need to have a minimum amount of money. And those are liquidity requirements. So at the individual level, there is requirements, capital and liquidity. So individual banks cannot create any amount of money. But at the system level as a whole, literally, I mean, theoretically, yes, they could create any amount of money. So at the system level, there's no limit of the amount of money that banks can create. So there we go to the difference between these two approaches. So basically, money multiplier pyramid implies this, like what we see in the left side. There's the monetary base, which is the money issued by the central bank, and that determines the size of the money supply. So central bank can actually determine the money supply. And commercial bank money, which is that money which is not physical, just numbers typed on a computer, and that is actually the vast amount of the total money which is in the economy, is determined only according to the initial money that was issued by the central banks. But this contrasts with this thing that I'm telling you now, because we're assuming now that the money supply has actually the shape of a balloon. We have the base money, which is the one set by the central bank, but then commercial bank money can expand as if it was a balloon. So this means that a central bank no longer has the full control of the money supply via a reserve requirement ratio. They have many tools to check that, the monetary policy, for example, but that's another story. So once we talked on this, we're gonna go back to the money creation process we were talking before. So yeah, this is a more stylized version of the example I was putting before. So now it's not us who have a farm. Now it's a guy called Will. So Will is that entrepreneur. So he has some money, 4,000 euro, and that innovative idea we talked about the cheese, but he needs more money. So he needs to ask the bank for more money because he needs to pay some people who will build that farm and who will milk the cows and I mean anything. So imagine this happens. Will gets a loan, 10,000 euro loan. So now he has 14,000 euro. He had 4,000 euro initially. With that money, now he can actually put in place his innovative idea. He can pay the builder of the farm 4, as you see in the graph. He can pay 10 to the farmer because he needs some milk. And it's important to think that with that money, not only he spends on his business, he also uses that money to consume himself. So he buys also 2 units of milk for own consumption. So we have 4, let's say 4 instead of 4,000, I think it's easier. So 4 to the builder and 10 to the farmer. So he spent all the 14 that he had. And then with that money, he could consume 2. Let's imagine that people in this economy can only consume milk and cheese to make it easier. So what happens in the end? He has a business now because everything is built, everything is functioning. So now he's getting money, he's earning money. So the farmer and the builder and also the bank realize that, yeah, the cheese is pretty good. So they're going to consume it for the value of 15. So Will is earning 15, and then he has to pay back the bank, obviously. So he was given 10, and imagine a 10% interest rate. So he has to pay back 11. So now he's back with 4,000 as the initial situation, but now it's better because not only he has 4,000, but he used 2,000 for own consumption, so his total income is larger than before, 6,000 versus 4,000, and he has a profitable business. He has a company which is producing something that society likes, so he has the means to generate more money in the future. So he's way better off than before. And this happened where when the bank gave him the loan. If the bank hadn't gave him the loan, nothing would have happened. We wouldn't have been able to create this business. Members of society wouldn't have been able to consume, and everyone would have been worse off. So the idea is that banks, by creating money out of nowhere, can develop, can make economy grow, can promote development and innovation because Will's cheese is like innovative and this is also valued by people. So that's the role that banks play in financial development. That's why banks are important because out of nowhere, out of the money they create, they can give fuel to those ideas. And those ideas means innovation, means more profitable investments taking place. If this providing that the assessment of banks is correct and that they only give loans to the people who are actually worth it. But well, banks have internal systems to control this, but well, this is not the point now. The point is that basically banks can create money, they expand the money supply, and if they allocate the money to those innovative ideas, they can boost the development and growth. And loans are the main important tool. Obviously, you could get money from the financial markets, for example, instead of going to the banks. But banks are important because banks create money. The money that is in the financial markets is money that already existed before and that is circulating in the economy. But it's not like new money. That's why banks are important. So in the end, everyone is better. Everyone gets benefited. And there's actually some empirical studies, some confirmation that says that countries in which the financial system is more developed, especially banks, have more economic growth and more capital allocation efficiency, which means that the capital is allocated in a better way to the companies which are actually worth it. There's that study from King and Levine, which is a little bit old. Later we'll talk about why I put that study there, considering it is so old. Like, why didn't I put something newer? We're going through this later. So yeah, this is the financial development side. So you probably think that this is too good. Maybe I've been paid by some banks to promote their activities or something. I'm bribed by them to pinkwash them. But yeah, everything sounds so good. Probably too good because we're basically treating banks as the heroes of the economy, but that is exactly not like this. Why? Because we've been talking about money allocated to the real sector, but we haven't talked about the financial sector much. Because banks can also give money to the financial sector, and we're gonna talk about what happens when banks do this. So to make it easier to understand, we're gonna have the same graph as before, but now we're including financial markets. So, okay, the first thing is the same as before. So Will still starts with 4, and he gets a loan from of 10 by the bank. With that loan, he buys milk, again for 10, 8 used for production, 2 for consumption, and then he pays 4 to the builder. Nothing has changed so far. But now, remember that in the previous example, the farmer and the builder really like the cheese, so they would consume 14 in total. I think it was like 11 the farmer and 3 the builder, I'm not sure. But now they think, well, I could actually make more money if I go to the financial markets. I can just, I don't know, invest in a pension fund because I want a nice flow of money when I retire. I want to buy stocks because I want to speculate in the financial markets. I don't know. But they basically they allocate less money to consumption and more money to the financial markets. What's the thing? Consumption is lower, so income for Will is lower. So in this scenario, he only has 8 of income plus 2 for consumption means 10. And the repayment is 11 because we remember we had a 10% interest rate, so we need to pay back 11. Now poor Will is in a little bit of trouble. And we just introduced the possibility of allocating money to asset markets, and that means Will might end up in bankruptcy. So you end up in bankruptcy, you have no money to continue your business. So the bank might seize all the assets. El banco puede apropiarse de los activos que tiene Will. Or maybe will have to roll over debt. Roll over debt is basically that you have to take more debt. You have to go to the bank and say, well, okay, I cannot pay you now, but if you increase my debt a little bit, then maybe I will be able to pay you in the future. So yeah, Will has, bad options because either going bankrupt or getting more in debt, getting more leveraged is always bad for him in this situation. So yeah, this is only when asset markets are introduced. And the thing is, for the farmer and for the builder, it might make sense to put that money on asset markets instead of consuming more. We're going to talk later about how individual decisions can be rationally good at the individual level, that individual decisions can be good for us, but then they can damage the system as a whole. We're going to talk about this later. But now it is important to note 2 things. First of all, that Will's business is actually profitable, is good, as we saw in the other example. But since money is not only flowing in the real economy, but in the financial economy, things are not going that good for him. So even if you have a good idea, a profitable idea, something that could work, that is not no guarantee that you will succeed. And secondly, it's important to take a look at the flows of the money, because we usually tend to think that we need some saving to then be able to create loans, and it's the other way around. At first, Will was given a loan, so lending took place, the bank gave him a loan, and then once he was given a loan, everything was moving. And I mean, maybe not in this example, but in the previous one, he got money from the consumption, so he got savings. So lending came first, and then savings came. So I think this is important because it's not really intuitive, but when you want to do something, you first need money. If you don't have money, then you cannot generate more money from that idea, so you cannot have savings in the future. So that applies to anything that we want to do when we don't have money. We cannot generate something because we cannot initiate the idea. And I think that's an important point. But going back to this, the thing is that now money is not only going to real economy, money is going to financial markets. And the problem with this is that many times this does not add a real value to the economy. Because, for example, in the previous example, when we give money to Will and he gets the loan so he can build a farm and he can establish his business, he can actually add a value to the real economy because there's like a profitable business, so it's good for him, who creates a product that society appreciates. So there's a benefit to real economy, economic indicators grow, there's been innovation and development. But if you allocate the money to the financial markets, okay, asset prices may rise. I don't know, stock share prices can rise, or real estate. Real estate is houses, basically, can rise its price, but it's the same thing. It doesn't necessarily add a value, especially to the real economy. For example, let's consider the real estate bubble. If you have a house, now the house values 300,000 euro, and then the prices increase, and now the house values 10% more. It's the same house, nothing has changed, just its price, but it's the same house. You're not getting more house, so you're just paying more for the same thing. So that is not adding any kind of value to the economy, and that is like a general trend that asset prices tend to follow. So the fact that asset prices rise doesn't necessarily mean, could be, but many times not necessarily, that the real economy is getting benefited. And since we talked about there is no limit for money creation at the system level, at the individual level, yes, system level, no. There is no limit on how high asset prices can go, at least in theory. So that is when speculative bubbles based on leverage apalancamiento, when you take a lot of debt, happen. Since asset prices are rising, you will be willing to invest more because you think they're gonna rise even more in the future. And that is something that happens to asset prices, because in normal markets, you probably studied microeconomics and the supply and demand curves and that thing. So usually when the price rises, then the demand is lower. So then the price in the end has to lower and to converge to a point in which the supply is the same as the demand. In the asset markets, it's not like this, because many times it works in speculation. If you think the price is gonna rise even more in the future, you buy. You buy because you think, yeah, now it's really high, but it's gonna rise even more. So when it rises even more, I'm gonna make a profit, and if I exit the market in time, I'm gonna have money. So this is the process that goes on. And many authors have defined this. I'm sticking to the definition by this guy, Epstein, who said that financialization is the increasing importance of financial markets, financial motives, institutions, and elites in the operation of the economy and its governing institutions, both at the national and international level. So basically, financial markets are the ones that determine most things in the economy, as we will see later with the market-based banking. But yeah, just bear in mind that asset prices rise usually lead to more asset prices rise. And we can illustrate this with some graphs, because if it's just me talking, maybe it won't be that clear. So the problem is, and this is like the reason why I included the paper from 1993 before about the financial development and economic growth, and I didn't include the further paper in time. Because if you take a look at the graph in the left, it's the US financial and business cycle. So you can see that until the 90s, more or less, they were a little bit more in line. But then since that, the financial cycle is bouncing a lot, is fluctuating a lot, while the business cycle is more constant, it's like similar shape. So this means that every time the financial sector grows more with respect to the real economy. So they are not growing at the same time. So every time the highs are higher, the lows are lower. And this does not have any effect on businesses, on the real economy. It's just the financial side of the system going more up and more down every time. So in the end, that means that every time there's less money allocated to the real economy, to wheel, for example, or to any real business sector, and more money allocated to the financial markets, bank money, commercial bank money, those numbers typed on a computer, those numbers going to the financial markets. And since the business cycle is like similar, and then the financial cycle is every time larger, then that means the higher percentage is allocated to the financial markets. And the fluctuations and the volatility are becoming larger as we see, because every time there's a rise in asset price, as we were talking before, asset prices rise, I don't know, share prices rise, house prices rise, and it can be anything. We take debt. How does it work? So imagine, you want to invest in stocks, and you think they're rising a lot, their price, but you think it's going to rise even more in the future, but you don't have money to invest. So you just go to the bank and say, okay, give me money, give me a loan, and I'm going to use this loan to invest in the financial markets. So I'm taking debt, I'm getting leverage, apalancado. So in this case, a lot of debt is flowing to the financial sector. And the thing is that that debt usually doesn't go away when the bubble crashes, because every time there's a bubble in the financial system, it crashes. It explodes at some point and we go down again. But that leverage is still there in the system. So as it said there in the slide, that's the growth in debt in the financial boom is not matched by the leveraging in the financial downturn. So every time we have more debt and more resources allocated to that financial markets. And as you can see, it's a trend that goes still until today. And if you take a look at the graph in the right, you can see that since the 90s, again, more financial growth doesn't mean more economic growth. So the financial system has grown a lot, as you can see, but there's been less economic growth. So it's like negative correlation. So the larger the financial system, the worse for the real economy. And that's the effect we're seeing today. And yeah, it's interesting to think of this because before it was not like this. And why does this happen? Why fluctuates? Now, to explain this or to give an insight on this, I want to talk about this guy. I don't know if you've heard about it. It's called Himaminsky. He was like an academician. I think, I'm not sure, but I think he was not super known before the financial crisis of 2007, 2008. But after that, he was really famous. I mean, he was dead when it happened, but still his theories were mentioned a lot because he formulated some economic theory that said that stability is destabilizing, because we many times ask, okay, if we go back to this, why these fluctuations happen? Why cannot we have stability in the system? Like everything's stable, everything grows at the same pace. Why do we have those highs and lows, those fluctuations? Because if we think of it as a process, we think of normal times. So in normal times, assets have a price, and then investors are quite confident that things are gonna be better in the future. They are enthusiastic. So we start buying more assets. So remember, in the financial markets, when there's more demand, asset prices rise. They don't fall, they rise because everything's based on expectations. And in this case, we have good expectations. So if we think something is going to have a bigger value in the future, obviously we buy. So investors buy more assets as the prices rise. So this is like a cycle. So every time asset prices rise, investors are more confident that things are going to keep like this in the future. I don't know, maybe let's say at first asset prices rose because the companies were doing really good and it made sense that they had more value. But then in the future, it's impossible to be growing at this level. So there's some unreal expectations of companies that will continue growing. So every time the investors want more, we want more, we want more. So as the prices start rising a lot, way more than companies can actually reflect. So companies are not actually that valuable, for example. I mean, could be in some individual cases, but let's say in general, no. But as the prices are rising, because expectations are good, because it was good at first, and then it's only gonna become better. So every time more high those prices, so investors end up going to the bank and saying, yes, I want a loan because I want to invest even more. So they take debt and the bubble becomes leveraged. Like we use a lot of debt to increase those asset prices. So in the end, it becomes unsustainable. In the end, asset prices reach a level in which they can no longer grow because investors cannot take on more debt. Companies cannot justify that increase in value because they are not generating enough profit. It's unsustainable. So everything crashes, as it happened, for example, in the 2007, 2008 crisis. So then the other thing happened. Everyone is really, really scared, and everyone wants to sell. Everyone wants to give away their stocks. Everyone wants to get rid of those financial assets because now they think, okay, the price is gonna get lower, and if I don't sell today, if I sell tomorrow, then I'm gonna sell at the lower price because it's the other way around. Like the asset prices are going low. So in the end, investors sell, go bankrupt. There's a crisis. There's economic contraction, and we go again to the first stage. When everything ends, let's say, we go again to a moment in which, okay, companies are starting to perform a little bit good and investors are enthusiastic about them. So they start buying more assets and then we go again. This is like a cycle, as you can see in the financial cycle, which is, as I told you, every time having more fluctuations because every time we're taking on more debt and more of that bank money that those numbers typed on the computer are allocated to the financial markets. So when we have stability, we're gonna be kind of enthusiastic at first. So we're gonna indirectly promote that asset prices to rise. So stability is destabilizing because we start from stability, but we cannot hold stability in time. We cannot maintain stability for a long period because stability tends to bubbles and those bubbles tend to fluctuations. So we cannot have stability in the financial system, the way it's organized. Stability is destabilizing. And the key point in this is that, I mean, because I'm talking, about speculators, about investors as the bad people here in this story, but I think we all agree that it makes sense that if we have money, we have €1,000, and someone says, okay, you go to the stock market and you buy stocks of, I don't know, any company, I don't know, Santander, for example. And if you buy stocks, then you're gonna get a return of 15%, like let's say, in a year, which is quite good. Inflation adjusted, 15%. We all would do this. It makes sense for us because we get more money. But what can be rational at the individual level, what can make sense for us, what can make us wealthier, might not be that good at the system level. The system might be harmed because we are creating, we are helping that bubble to grow. We are fueling that bubble. But it makes sense for us. And that is a problem where you have many individual actors and all of them have incentives to behave in a certain way. And it makes sense for them to do it. It's really, really hard to stop them from creating those bubbles, from destabilizing the economy, because it's what everyone would do. Because obviously everyone's thinking about themselves. We're not thinking about the system as a whole. And this is the reason why stability can be destabilization. According to Minsky, he actually said that regulation was really important to prevent this from happening or to control it, because he said that this is always going to happen. This is the way the system works. We can only have a certain amount of regulation to stop this, a little bit to control it. So this goes further in the problem of rents. What is rents? Rents is basically any revenue connected to the ownership of an asset above and beyond the costs required to maintain the asset. Easy. Imagine we have, I don't know, a house and we're giving it for rent. We're hiring the house to someone, like, those student houses, student flats in La Laguna, which are really old. I know, I've been there as well. So we have that one, and we're renting it to two students, for example. We have, as the people who are renting the apartment, we have certain costs that we have to incur. I don't know, we need to pay. Imagine in the contract, we say that we need to pay for water, for electricity, for, I don't know, anything. And then, maybe we need to do some maintenance to keep it clean, everything. So, okay, those are the costs that are required to maintain the asset because, the apartment is an asset in good condition. But anything beyond that, any cost that we're charging more from that level is a rent because we're extracting money from the other people. So what's the thing with rents? rents are bad because we're kind of extracting money from the real sector. I mean, I really like the real estate example here because I think it's really intuitive. So, for example, house prices. Imagine a house that was worth 300,000 euro yesterday, and today, because there's a bubble in the real estate market, there's an increase in asset prices. It values, I don't know, 400,000. So we pay in 100,000 more euro for the same thing. We're not having a value added because usually we say, okay, we pay more, we get something better. But we're not getting something better. We're getting the same thing, but more expensive. So some rents, I mean, the rents are extracting actually money. And for example, you and me, we're gonna have some trouble in finding or buying a house in the future because now house prices are double or triple compared to the prices maybe 30 or 40 years ago. So we're paying maybe twice or three times more for the same thing. And this is a problem because no one gets benefited from this in the real economy. The economy doesn't grow if asset prices rise and rents are extracted. And again, it makes sense on the individual level. Like imagine you, I mean, obviously, if we don't consider ethical issues, because it's bad to do this. But imagine we have a house, we're renting it, and we're renting it for 5,000 euro. And one day we wake up and we say, no, we want to make more money. No, we're gonna rent the house for 700 euro. So the people we are renting the house are gonna pay 200 euro more every month. And we tell that to them. And they say, well, okay, because we don't have any other place to live, or doesn't matter. They're paying 200 euro more for the same thing. So we're extracting rents from them, but we are getting benefited because we have more money. So, I mean, again, taking aside the ethical considerations, it makes sense for us to do this because we get more money, we are more rich. And this is the problem. Again, what makes sense at the individual level is harming the system as a whole, especially considering the system as real economy. And all actors do this. Banks also do this. But don't think that banks do this by increasing the interest rate, because this is not really beneficial for them. Because if you increase interest rate, then you're gonna have the riskier borrowers. You're gonna have really bad borrowers. So it's not worth it in the end. What banks do is they just promote speculation uh, to happen by increasing the loan supply. They're giving more loans, they're giving more money, creating more money out of nowhere, typing every time more digits on a computer, more numbers on a computer, and increasing the money supply, increasing the loan supply for speculation as a bubble purposes and rent extraction purposes. And this is basically financialization. So banks are also involved in this practice, and this is what happens when banks focus on allocating that money to the financial sector. And this leads to the final conclusion or idea that I want to mention, that this whole thing that I've been explaining for half an hour has this effect. Banks are no longer following the traditional banking model. We are going to something called market-based banking. So, okay, traditional banking is banking as you probably think of it, as we were told in school, in high school. So banks just make loans to customers, and those loans, you keep those loans on the balance sheet and hedge. And hedge means that you don't cover them for losses. Simplemente te quedas con el préstamo en tu balance. Y ya está, lo tienes ahí. Es tu activo. Those loans are going to be financed by deposits. Okay, loans financed by deposits. Make sense? We have stable sources of financing, and lending decisions are driven by the individual bank's view of a company's credit worthiness. So if I'm a bank, I want to give you money, then I think, okay, who are you? How are you going to pay back? Do you have something to give me in case, like a collateral, for example, that you can give me if you don't pay back? So I, as the bank, carry out the assessment. I decide if you are worthy to be given the loan or not. So once that decision is given, then the profitability of the bank's decision is determined by the borrower's payment of the interest and repayment of the loan. So basically, as a bank, I make money just because I gave a loan to someone, and then I'm getting back that money with an interest, which is usually larger than the one I'm giving to customers who have deposits. So interest of loans higher than interest of deposits. That means I'm making money, and that's like traditional banking. But since everything that I told you is going on in the economy, we're going from that to market-based banking. What is market-based banking? So banks are no longer keeping the loans in the balance sheet. They sell the loan to the market via securitization. I don't know if you talked about securitization in the course. I think you should, or at least when I took it, we talked about the CDOs and everything. But basically, securitization means that you become the loan, you make the loan a tradable asset. So you sell the loan to the market, and that is an asset. And the asset you're selling, you're creating a new asset, is backed by the loan. So the loan is like a collateral of the asset you're selling to the market. And you give loans not to make money from the interest that they pay you back. You're making loans because you want to sell them to the market and obtain profit via that way. So what happens is that the market is eventually who decides the terms of the conditions of the loans. So you as a bank don't have the, how do you say, you cannot decide the interest rate, for example, or the conditions. Those are determined by the market, and you have to follow what the market says. You are no longer in control of your own loans. The market's telling you everything that you need to do. So that actually constrains that ability of banks to decide on their own future. And also because loans are no longer funded by customer deposits. Like it's not customers with the deposits give us money, and they with that money we can ensure that we have enough liquidity, enough capital, etc. No, we go to the market to fund ourselves. We have market-based liabilities. So everything's based on the market. So loans are hedged against risk. For example, via CDS. CDS is credit default swaps. Basically, like an insurance. It's an insurance. So if you think there's a risk of default like impago, you can go to the market and buy a CDS, which means that you're paying some money so that it's like a insurance premium. I think it's better if I explain in Spanish. Basically, es como pagar una prima cada cierto tiempo para asegurarte de que si el préstamo incurre en impago, a quien le estabas pagando la prima, al asegurador, por decirlo de alguna forma, te va a devolver la cantidad que has perdido. Es como un seguro, por decirlo de alguna forma. So everything is determined by the financial markets. And this is the banking model we're having now. We're switching to that model, from the traditional banking model to this model. This is happening right now. And in Spain, of course, but as we'll see this here, in different economies, it's going at different paces. So in the financial crisis, this really had an impact because this makes banks vulnerable. We depend more on the market. So, it's really easy to understand. If markets go bad, banks go bad. If markets crash, banks crash, because banks are heavily dependent on markets, on financial markets, because since we rely on the market for everything, for giving loans, for getting funds, for everything, we're tied to the financial cycle. So banks are not just outsiders who are just feeding the financial cycle. Banks are part of the financial cycle. So when things go wrong, then banks are more likely to crash. So for example, a really used and clear example, practices such as securitization. as we were talking before. So we had the 2007-2008 crisis. What did banks do before that? They had loans. Okay, I gave a loan to a person. This is an asset for me. What I'm gonna do with this loan? I'm gonna keep it on my balance sheet? No, I'm gonna sell it in the market as, for example, as a CDO. That's related to mortgages, to hipotecas. So basically, you sell the loan and you get, for example, I don't know, you create a company with that purpose of selling the loan and you get shares of that company. So you still have an asset, but your asset is no longer your loan. Your loan was sold. Your asset is the shares of the company who you sold that loan. So if the shares, if that company rises in value, your assets are going to be higher. So you're dependent on the market. And then your loan is going to be sold many, many times in the market. And so then you're going to give more loans to people so that you can sell them in the market. I mean, I don't want to expand a lot of this. I don't want to extend myself talking about this because it's like a huge topic, which I also think Judith's gonna talk about in class. But basically, such practices were really, really common because it was profitable at that time. But banks were being part of the financial cycle. So when everything crashed, when people no longer trusted these obligations, their value decreased. So since the balance sheets of the banks were heavily, heavily dependent on those market-based assets and liabilities, they also crashed and collapsed. So we can see this graph here. This from a paper by Hardy and Howard. So we can check the level of market-based liabilities and market-based assets. So market-based means that they come from the market. So for example, market-based liabilities are when you get funds from the market. You go to the market to finance yourself. And assets were the same, but in the asset side. So if you are more to the right and to the top, that means more market-based banking. Well, I have to say that in this figure, the point for the US is not really precise because these authors didn't take into account some other institutions who were like banks before the crisis. But forget about the US and focus on the other countries. We see, for example, that the UK and the Netherlands were the countries which were more affected by market-based liabilities and market-based assets. So when that happens, you usually suffer more, especially in early stages. Like, because in the end, we all of us suffered during the crisis because everything is interconnected right now. We live in a globalized economy, and in the end, almost all the countries had done this. So yeah, in the end, all of us are going to be affected. But in early stages, like at first, the more connected you are to the market, the worse it's going to be for you at first, because the market crashes and immediately your balance sheet crashes. Your assets go down, or you no longer can finance, because if you trusted in the market to get funds and you can no longer access the market, then you cannot finance your assets. So this is a good example. The financial crisis is a good example of how these practices actually had an effect on banking. So yeah, I think this is the most important takeaway. After the crisis, there was a lot of efforts by regulators, by the central banks, to prevent this from happening. So now the requirements are tighter. For example, capital liquidity requirements that we talked about before, they are more strict now than before, and we're developing new frameworks to make it even more controlled every time. You probably heard or will hear soon about Basel agreements. So yeah, we're just trying, as Minsky said, to impose some regulations so that this does not happen again. Or at least if it's happening again, because fluctuations just tend to happen, it's not, it doesn't have that of an effect. But market-based banking is growing. It's becoming larger every time because it's like the new model that we have to finance everything. So yeah, in order not to make this too long, this is almost about to finish. I also know that online it's probably more boring than in person, so no worries because we're almost done. I just want to remark the 3 takeaways that I think you should have from this, like what you should think once we've done. So banks are needed for for economic growth. They really play a key role in this because loans are what fuel innovation, development. All these things can happen when banks give loan to people who otherwise would not have money to carry out those investments, those projects, those ideas. So bank money is necessary. That bank money, which is just numbers typed on a computer, don't think of physical money because physical money is, I don't know the percentage, but for sure less than 5% of the total money supply. I'm quite sure that is less than that. So just think of numbers, but those numbers created by the bank can have a huge impact in development. Well, I mean, here it's important to mention that obviously not only banks can finance those things, and actually banks won't always finance things which are profitable or like beneficial for the society. For example, education, healthcare, those are things that usually need to be funded by the state, by the government, because they're not profitable for the banks because, you know, it's harder to make a profit from those, but still they are needed for society. So yeah, the public sector has to intervene. So I mean, that's another story. I just don't want you to think that banks are exclusively the ones who can fund things which are good for society, because in many times banks are not willing to do that, and for example, the public sector, the government needs to step in. But yeah, have that in mind that banks are important for this. But the problem is that with increasing financialization, increasing importance of financial markets, financial institutions, everything, this is less likely to happen, let's say, because less growth in the economy. We saw the graph in which there was less real growth when the financial growth was higher, because banks are allocating that powerful tool, that money, to something else, to increase the bubbles, to increase the financial cycle, and in actually taking part on it. And this is the last bullet point here, like market-based banking is a new tendency. Market-based banking, in short, is just banks are not only providing economic support to the financial cycle, but only being a part of it. So everything is interconnected. Banks are interconnected with financial markets, and their effects are, I mean, they affect each other by their actions. So when one crashes, usually the financial system, the bubble crashes at some point, it explodes, then banks go, you know, follow them. And this is what we've been seeing in the last years. So I think this is interesting to think of this, especially of ways to mitigate this. That could be like a new topic, a new lecture, which probably will be quite interesting, but I don't want to talk more than this because I know online lectures are not the best format for talking about this, but yeah, I just think this is an interesting way of seeing things, especially because banks are things that people think of as, you know, either black or white. Some people think, oh no, banks are really, really good. We need banks. Banks are cool. Financial systems are good. Stock markets are cool. And some other people say, no, it's just speculation. It's harming development. And I mean, it's both of them are like true at the same time. Banks are necessary. Banks are necessary. Financial markets are necessary, but that doesn't mean they function in the best way all the times. And I think this is important to keep in mind. So yeah, I think this is everything from me, at least from this, I don't know, thing I'm talking about. So well, creo que puedo hablar en español ya. Yo creo que esto es todo. Sí, supongo que es momento de pregunta, de lo que sea.
Las preguntas.